So basically, just to give you some background, this project is also us trying to think about global residual profit allocation, and not only in relation to the taxation of highly digitalized businesses, i.e. Pillar 1, but also what is residual profit allocation as an alternative feature of taxing corporate profit comparing to the current system. So given that it's been highly discussed in the policy debate, we feel like we should try to understand a little bit better of the residual profit allocation. So that's where the project started. And then as you can see, this is joint work with 4 other colleagues at the Fiscal Affairs Department, i.e. all the tax nerd in the FAD. And the standard disclaimer apply. This is our own view and not the official view of the IMF. Okay, so just to basically capture the idea, what is RPA? And I guess many of you have already heard, it's basically a hybrid system. That is, you take the total profit of a multinational company and then try to divide into 2 components. So the first component is the routine profit, which basically, as you heard, is the return to the standard functions and activities that can be basically benchmarked with some other third-party functions or activities. And then you allocate the part of the profit, which is routine, by arm's length principle to the source country. So that's where it's basically preserving some element of the current system. Then the rest of the profit, i.e. profit net of routine, is the residual. And here the RPA would allocate this part of the profit by formula. So either you can sort of think some formula as you heard, if it's based on, say, user participation or marketing intangible, then that's basically you can use the formula to allocate to the market country. But more you can sort of think of using some conventional formulas, as we heard from, say, the formula reapportionment, i.e. capital employment. So actually what we are trying to think about is a family of residual profit allocation that is not tied to some specific formula. So you can think of the Pillar 1 also as a special case of the RPA, that is, it aims or it's discussing allocating some elements of the residual to the market country. And I think it has been emphasized residual profit split is actually not a new idea. So it's already in the OECD transfer pricing manual, although it's currently applied, say, only to specific transactions on a case-by-case basis. So the idea is not entirely new, but it has never sort of been applied as sort of an overall whole to the current system. So how should we think about this hypothetical tax system, and how do we sort of understand whether it's a better system comparing to the current system? So that's where we start from. So basically, if you think about the approach of allocating profit, RPA is based on unitary taxation, i.e. it takes the profit of the multinational group as a whole. So theoretically or conceptually, it substantially eliminates many of the incentives for profit shifting under the current system. So we would say that, as also you heard from John, it's going to basically eliminate many of the tax avoidance opportunities. But what about its efficiency and revenue impact? i.e., is it more or less distortive to investment comparing to the current system? And how much are we really talking about, say, the scale of routine and residual on a worldwide basis? And I think from the country's perspective, they are also quite concerned about the revenue implication of an RPA. So, i.e., who is the gainers and losers in terms of getting more revenue under the RPA system? So that's the set of questions we try to answer or explore, so to speak. So just basically to put things in perspective, and apologize for the formulas, there is sort of model that guides, say, our assessment of whether the RPA is more or less distortive comparing to the current system. It also gives us some sort of theoretical insights as to how to sort of calculate the revenue impact of moving towards a RPA. So that is to say that we're not just merely playing with numbers to get either the efficiency implication or the revenue implication of moving to an RPI. So just to give you a flavor of this theory model, I'm not trying to go through line by line, but what I want to try to convey is the theoretical approach try to tie as much as, say, the basic idea of RPA. So think about what is the routine profit of a multinational in each country. Well, theoretically, it's just basically some fixed rate of return to its underlying investment in each country. So what is the total residual? Then it's just going to be the total profit before financing cost minus all the routine, so the worldwide routine of this multinational. So what about the taxation of routine versus residual? Each country can tax routine profit at a rate of T, and then they get allocated with some allocation key, a portion of the total residual, and then they can apply different, either the same or the different tax rate, which is taxed at tau. So the total tax payable from, say, the perspective of multinational in each country is just basically the tax on routine and then the tax on residual. And then under the RPA scheme, the multinational has the same problem of maximizing the total after-tax profit under the RPA. So that's basically the idea of the model. And what I want to highlight is that the residual, the tax rate on the residual is going to be, so it's going to be the, so where you see the W is going to be the weighted average of tax rate on the worldwide residual. Okay, so what about the efficiency aspect of the global residual profit allocation? So Mike already waved his hands on how should we evaluate about the economic efficiency. And for all the tax experts, it's the marginal effective tax rate. So you can think about if this parameter is higher, it means it's more, the tax system is more distortive to the investment, and then you should expect to see a lower investment in equilibrium. So the marginal effective tax rate under RPA, actually you can see can be sort of decomposed into two components. And the first component is that what we're familiar with because it's taxing on the underlying investment. So that's basically the taxation of routine profit. And then there is a second element which relates to the taxation of residual. And then what are the insights from this model? Well, it's quite interesting. The second term would vanish, i.e., if the average weighted tax rate on residual does not depend on the underlying capital or investment in each country. So basically, that is to say, it's going to be zero with fixed weighted average tax rate or with fixed allocation key that does not change with the underlying investment. So you can think about destination-based sales. If you believe that the destination-based sales really doesn't vary with the actual investment of multinationals, then the second component would vanish. But if you are thinking about, say, in a more traditional formula apportionment approach that we're allocating based on, say, the capital or the employment, that would change, say, with the underlying investment, then the second component would not vanish, i.e. the taxation of rent or the residual profit would also distort investment. And then you're going to see that it's going to be more distorting if the shares are allocated to the lower tax jurisdictions in order, so that multinationals can sort of lower their overall tax burden on residual. And what's also interesting is that this distorting impact of the taxation of residual profit component is going to be stronger the larger the overall residual profit of the multinational. So that's so much of the METR under RPA. How do we think it's higher or lower compared to the current system? So the model also gives us some insights of relating between, say, the METR under RPA and the standard effective tax rate under the current system by a really nice formula. So I'll just tell you what this formula says in words. So if you sort of ignoring profit shifting for a moment, then the METR is basically the standard cost of capital based on the standard cost of capital under separate accounting. So the RPA would basically say the METR would be lower in countries where their tax rate is going to be higher than the weighted average tax rate. So that is to say, it would encourage investment in countries which taxing residual profit at a higher rate than the weighted average of such rates. Or you can just think about it's going to encourage investment in higher tax locations and discouraging it in lower tax countries. But if you wait a moment and think about how does the profit shifting come into play, and actually that's basically what motivated the whole BAPS process. So again, in words, profit shifting, because sometimes you can sort of, the investment in the specific country it may enable you to avoid, right, or to escape the distortive corporate tax system in a specific country. It sort of lowers your effective METR comparing to that you can't sort of do tax planning and profit shifting. So the METR under the current system sort of incorporating the possibility of profit shifting would actually be lower in every country comparing to what we see in the standard METR. So that sort of gives us some other really interesting observation is that, well, if you sort of considering profit shifting, under the RPA, it's still unambiguous that lower tax jurisdictions are going to see an increase in their METR, but the METR in the high tax countries are going to be unambiguous because their METR are currently lower than what the formula says. So ultimately, it's going to be an empirical question to see that whether the METR in high tax countries would increase under the RPA. Okay, and then the model also gives us some guidance as to how to back out the revenue impact of moving towards a RPA. So, I mean, the total revenue impact is going to be even a longer equation than what you see here because it sort of incorporates all the revenue impact from changes in investment. But here it's just basically from the reallocation aspect of RPA. And again, this is really simple once you look at it for a long time. When would a country see an increase in their revenue under the RPA system? Well, it's going to see increase in its revenue if its allocated share of residual is higher than what it's currently getting, i.e. what is the share of reported profit from this multinational company under separate accounting. And if you are willing to sort of even take a step further and assume, say, the specific functions of cost in shifting profits and also sort of using current estimates as to how sensitive the shifted profits with respect to the current statutory corporate tax rate, that is the semi-elasticity of profit shifted, then we can even further decompose, say, the total revenue change into two elements. One is, say, what is the revenue impact, say, from elimination of profit shifting under the current system, and then what is the reallocation aspect of sort of assigning all this taxable profit. So that's so much about the prep work, but I guess we already sort of learned a little bit of RPA. Then what can we learn also from the data? So here I have to sort of highlight the empirical challenge. As you probably know, there is no one standard data set that captures, say, the comprehensive global activities of all multinationals in the world. Country by country report may do, but I mean, that's something that's basically not currently available to us researchers. So we basically try to sort of use different data sets to say as much as possible about different aspects of RPA. So the first thing we do, and also which is model-free, is that we want to understand what is the scale of residual profit we're talking about. So what we did is get this consolidated financial statement of the largest 10,000 multinationals in the world. And then that's from the S&P Capital IQ. So it's a panel data, so you can sort of look into the dynamics a little bit to look at the scale of routine and residual profit on the global base, on the consolidated basis. So key features of this multinational, I'm not going to read the numbers, but in essence, they are large. And the smallest one in this data set is well above the threshold for country-by-country reporting or the EU CCCTB threshold. Okay, so what do we learn about the scale of routine versus residual? So basically, you have to basically say how much you are willing to determine the routine profit, and then there were different ways to determine the routine profit. One approach is to say, I give a fixed return to the underlying asset, and the alternative, as John hinted, is basically this cost markup. So we sort of not basically leaning towards one, but we try to sort of see what are the scale of residual under alternative ways of determining routine. So this is the set of results with assumed routine rate of 7.5 to the underlying fixed investment or 7.5 of cost markup. So total residual is about 60% of total profit of these largest 10,000 multinationals, while for a small portion of them, between 13 to 20%, they do report negative residual. And then that highlights the practicality of how do you allocate negative residual, although many of these residual are temporary. So not many multinationals consistently have negative residual over their lifetime span or within the sample period. There is a large variation about the scale of residual across sectors, and then that basically highlights the trade-off between simplicity, that you use one rate of return for all multinationals, versus accuracy. And another interesting feature is that residual profit are highly concentrated in a small number of multinationals. About 30% of all residuals are sort of in the top 1% forms. And another interesting observation is that if you look at the distribution of residual by the headquarter of these multinationals, then between 30 to 40% of the residual are in US-owned multinationals. And then that basically is going to give you a sense of practical political difficulty when we talk about allocating this residual profit. And then what about the revenue impact of moving to an RPA? So as I said, the general RPA can rely on different formulas to allocate the residual. Here we looked at the allocation by a proxy of destination-based sales. Then we use a different data set, which is basically the aggregate fixed capital stock and total CIT revenue. And basically this proxy for sales for about 120 countries in year 2016, which we collected from different data sources. And again, this is basically to assess the changes in the CIT revenue if moving to a destination-based sales RPA. So what can you see from the revenue consequence of moving to a destination-based RPA? I have to say this is still work in progress. So please don't quote us on the specific numbers. But here it basically shows the revenue impact for all countries in our sample ranked by their log of GDP per capita. So countries here are basically lower income countries, comparing, say, to the Nordic countries and the US, where you see high income countries. And the vertical axis basically shows you the revenue change when moving to an RPA as a percentage of current CIT revenue. So what can you see? Well, basically the first observation is that a lot of countries see sizable revenue change. So actually more than 70% of countries see an increase or a reduction in their revenue, more than 20%. And then among the highest gainers, well, you can see that there are many of them are developing countries. So Uganda, Yemen, Benin, and the largest gainer is Argentina. And then if you're moving into the countries that are losers, then you see that the largest one is Cyprus, which is going to lose more than 80% of its current revenue. But then you also see sort of the traditional investment hubs, Ireland, Malta. I mean, you get the idea, Netherlands, Switzerland. So basically, this is the country-specific results. But I guess a really other interesting pattern is that the extent of revenue change is negatively associated with the level of income. What does it say? It says, well, lower income countries are going to gain more when moving to an RPA. And why is that the case? Well, if you flash back, the model does allow us to basically say how much of the revenue revenue change are due to elimination of profit shifting. So we also know that lower income countries are more vulnerable to profit shifting. So if we basically try to decompose the total revenue change to say the part that is due to elimination of profit shifting, and then the part that is due to reallocation of the residual profit. So on a country group basis, you can see that in total, on average, lower income countries would gain from moving to an RPA. So basically all the black dots summarizes the total revenue change when moving to an RPA, while the different blue bars are going to summarize what is the component related to elimination of profit shifting. And then the lighter blue bar is basically what is the percentage of revenue change due to elimination of profit shifting. Here, basically, you can sort of, so the low income country, the extent of revenue change due to elimination of profit shifting is quite small, but then that's basically a sample feature because we don't really have a lot of these low income countries, but we do have quite many lower middle income countries in our sample. So, and then you can see that high income countries will in total lose from moving to an RPA. Okay, so I'm out of time, so I'm not going to basically tell you how the METR is going to change under the RPA. But then again, the basic relation is the same as the theory predicted. Higher tax countries are going to see a reduction in their METR, and then lower tax countries are going to see an increase in their METR under the RPA. Okay, so just quickly summarize, what did we learn from this exercise? Well, RPA is going to sort of eliminate many of the profit shifting activities or opportunities under the current system, but it will still retain inefficiency for investment as we see from the estimates of the METR. And what we also learned from the revenue impact is that the reallocation of RPA, at least based on this sales proxy and elimination of profit shifting, are going to be attractive for many lower income countries. And then we sort of, because this is a work in progress, so there are definitely other interesting things to explore, but I will just stop here. Thank you.
Thank you very much.